Hello fellow compounders, welcome back. In our last video, we started exploring my favorite investment strategies, starting with Warren Buffett's approach, followed by coffee can investing, and growth at a reasonable price by Peter Lynch. Today, we're continuing the series with dividend growth investing, high yield dividend investing, and passive index investing. Each strategy will be unpacked with real-world examples outlining their benefits and challenges. So let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. Dividend growth investing, or DGI, is a strategy that centers on companies consistently increasing their dividend payouts over time. This approach combines the benefits of income generation with the potential of capital appreciation. Dividend growth investing has been a preferred strategy for many conservative investors who value steady income along with moderate capital growth. It's based on the premise that companies that regularly increase dividends are financially healthy and stable. In dividend growth investing, dividends are more than just an income source. They're indicators of a company's financial wellness and growth potential. Rising dividends often suggest strong cash flow and confidence from management in future earnings. The strategy is not just about high dividend yields, but rather about the growth rate of these dividends. Sustainable and increasing dividends can lead to compound returns over time, making this a powerful component of long-term wealth creation. Let's take, for example, Procter & Gamble. Procter & Gamble exemplifies this strategy. Known for its wide range of consumer products, P&G has a strong track record of increasing its dividends for several decades, showcasing financial resilience and commitment to its shareholders. If I had invested $10,000 in Procter & Gamble in 1988 when I started college and reinvested all the dividends, I would now have close to $676,000, a 12.4% annualized return. That's in comparison to $400,000 which I would have if I had invested in the S&P 500 instead. Let's analyze P&G's dividend history. We see a consistent upward trajectory in dividend payouts, underlying the company's ability to generate and increase cash flow over time, which is a key attraction for dividend growth investors. Currently, its dividend yield is around 2.5% and its dividend is expected to grow at a 6% rate over the next 3 years. This strategy suits investors who seek a balance between income and growth, particularly those in or nearing retirement. It's ideal for risk-averse investors who value consistency and stability over high yet potentially risky returns. Dividend growth investing offers a prudent blend of income and moderate growth, making it a cornerstone strategy for many long-term portfolios. It exemplifies the adage that slow and steady can win the race in the investment world. Do you focus on dividend growth in your investment decisions? What companies do you think are the next big dividend growers? Share your thoughts and picks in the comments below. Shifting our focus, we now explore high-yield dividend investing. This strategy targets stocks offering high dividend yields compared to the broader market average, appealing particularly to investors who prioritize regular income. High-yield dividend investing is not just about chasing the highest dividend yields. It's about finding companies with sustainable business models that can support these high payouts over the long term. A crucial aspect here is understanding dividend yield, calculated as annual dividends per share divided by price per share. While a high dividend yield can be attractive, it's essential to assess the reasons behind it. Sometimes, a high dividend yield can signal a company in distress where the stock price has fallen sharply. Investors need to evaluate whether a company's high dividend is sustainable. This involves looking into its payout ratio, earning stability, and overall financial health. Let's take, for example, Altria Group, ticker MO. It's a giant in the tobacco industry, and it has historically offered high dividend yields. Despite regulatory and market challenges, it has maintained substantial dividend payments. Let's analyze Altria's dividend yield over time, juxtaposed with its stock price and overall financial performance. These comparisons can reveal insights into their sustainability and high dividend yield. Altria, by the way, is a dividend aristocrat. It has increased its dividends for more than 25 years consecutively. Altria's current dividend yield is 9.5%, making it an attractive choice for income-focused investors. However, assessing its payout ratio and revenue stability is key to understanding the sustainability of these dividends. Its current payout ratio is 77.6%, which is quite high. However, when we look at the industry's payout ratio, the average is 84%, and Altria's cash flow is highly predictable. Therefore, Altria's payout ratio is quite acceptable in my opinion. The main advantage of high-yield dividend investing is the potential for a significant and steady income stream, making it particularly attractive in a low-rate environment. However, it's vital to be wary of the risk, including the potential for dividend cuts if a company's financial situation deteriorates. There's also a need to stay vigilant about industry-specific risk. This strategy is best suited for income-focused investors such as retirees who are seeking a regular cash flow from their investments. It requires a careful assessment of each company's financial health and the sustainability of its dividend payments. High-yield dividend investing offers a compelling avenue for income generation, but it demands astute financial analysis and a cautious approach to selecting stocks. It's a reminder that high rewards often come with high risk. What's your approach to high-yield dividend stocks? Do you have favorites or criteria for selecting them? Join the conversation and share your insights in the comments below. Now, let's move on to our final strategy of this series, passive index investing, or index investing. This approach is about simplicity and efficiency, focusing on long-term growth through market index funds. The core idea is based on the efficient market hypothesis, which suggests that it's difficult to consistently outperform the market. Instead of trying to beat the market, passive index investing aims to match its performance. Index funds are designed to track the performance of specific market index. What's the appeal of index funds? Index funds are designed to track the performance of a specific market index, like the S&P 500 or the CRSP US Total Market Index. They offer broad market exposure, which helps diversify investment risk across a range of assets. One of the biggest draws of index funds is their low expense ratios compared to actively managed funds, making them an attractive choice for cost-conscious investors. A popular method within passive investing is the Bogleheads 3-fund portfolio, advocated by followers of John Bogle, the founder of Vanguard. It's a simple yet effective way to build a diversified portfolio. The 3-fund portfolio is composed of, you guessed it, 3 funds. The first one is a total US stock market fund, like the Vanguard Total Stock Market ETF, VTI, which covers a wide spectrum of US stocks. Second is an international fund for global exposure, like the Vanguard Total International Stock Index Fund, ticker VXUS. And the third fund is a bond index fund, like Vanguard's Total Bond Market Index Fund, or Market ETF, ticker VND. Passive investing offers several benefits, including broad diversification, reduced risk through market exposure, and significantly lower fees. It's also a time saver, eliminating the need for constant market analysis and stock picking. You simply just own the entire market. However, this strategy limits the potential for above-market returns since it's designed to mirror the market performance. Additionally, in market downturns, the portfolio is directly impacted, reflecting the overall market decline. This approach is ideal for those who prefer a hands-off investment strategy. It's especially suited for beginners or long-term investors who seek a diversified, low-cost and passive approach to investing in the stock market. Passive investing, particularly the Bogleheads 3-fund portfolio, is a testament to this power of simplicity in investing. It's a strategy that underscores the benefit of patience, diversification, and long-term outlook. I made a video comparing the Bogleheads 3-fund portfolio approach to Warren Buffett's index investing approach. Here's the link. Do you use passive investing strategies in your portfolio? What are your thoughts on the Bogleheads 3-fund portfolio? Share your experiences in the comments below. So there you have it, the last 3 of my favorite investment approaches. If you haven't seen part 1 yet, here's the link. Thanks for watching. Remember to always be compounding. See you in the next video. Take care.